A very warm welcome, everyone. My name is Nadiah Jaafar from Kenanga Futures Neighborhoods, and I will be your host for tonight's webinar entitled Trading in Futures: How to Get Started FCPO. Thank you for spending our precious time to join our webinar today. We have returned with our nationwide campaign, Accelerate into the Future. Stand a chance to win prizes worth up to 50,000 when you trade Malaysian and US futures contract from 2nd August 2021 till 29 October 2021. Please take note that this webinar is purely for education purposes and is not in any form or manner of trading advisory. Kenanga Futures Number accepts no liability whatsoever for any direct or consequential loss arising from any use of the contents of this webinar. Before we start, we would like to take this opportunity to invite you to Kenanga Futures Net webinar on 17th August 2021. It's about risk management and trading plan. An invitation email will be sent again to you. Don't miss out. Please remember to register once you receive the email. Next, if you have any question for our speaker, please feel to post your question through chat box, and we will attend to your question during the Q&A session. To post your question, please draw your attention to the bottom of the chat box. Please click on the text bubble icon and it will be switched to Q&A chat. You may type in your questions in the chat box. Today, we have Ms. Janchi here, and she's going to share with us about trading in futures, how to get started FCPO. So without delay, I would like to kickstart our webinar by welcoming our speaker today, Ms. Janchi. Over to you.
Okay, thank you, Nadiah, for the introduction. So good evening, everyone. Thank you for attending our webinar tonight. My name is Jan Lim, and I am a Sales and Dealing Executive with Kenanga Futures. In today's webinar, we will be discussing a few basics on futures trading, as well as some of the fundamentals. So just a short disclaimer, the information that is presented tonight is purely for educational purposes only, and it doesn't represent any advice or recommendations for any of your trades. So this is the agenda for today, some of the topics that I will be covering in today's webinar. We will begin firstly with the concept and definition of derivatives. So have an overview of the futures market, talk about what you need to know about futures, about trading futures. And then finally, we end our session with an example of a simple trading strategy with the FCPO, or the crude palm oil futures contract. So let's begin with the concept and definition of derivatives. A derivative is a financial security with a value that is derived from an underlying asset or group of assets. The derivative itself is a contract between two parties, and the derivative derives its price from fluctuations in the underlying asset. So the most common underlying assets for derivatives are stocks, bonds, commodities, currencies, market indexes, and interest rates. So the investor doesn't own any of the underlying asset and instead uses derivatives to make a bet on the price direction of the underlying asset. The derivatives have numerous uses while incurring various levels of risk, but are generally considered a sound way to participate in the financial markets. So investors typically use them to hedge a position, to increase leverage, or to speculate on an asset's movement. A quick review of the terms that I will be using throughout the session. Derivative trading is difficult for the general public to understand, partly because they have a unique language. So what is long or short in derivatives trading? Being long a derivative means that an investor has bought the derivative with the expectation of a price increase. Whereas being short a derivative means an investor is a seller of the derivative with the expectation of a price decrease. So being bullish means a trader or an investor believes the asset or the overall market will go higher. Conversely, being bearish is the term used for traders who believe that the asset or the market will go down or underperform. So a bullish trader is often referred to as a bull, and a bearish investor is often referred to as the bear. Derivatives can be bought or sold in two ways, either over-the-counter or in specialized exchanges. So over-the-counter derivatives, are contracts that are made privately between parties in an unregulated venue. On the other hand, derivatives that trade on the exchange are standardized contracts. So there are three main classes of derivatives. These include options, swaps, futures and forwards contracts. Today, we will just be focusing on this category as futures and forwards, as they are the most commonly traded derivative contracts. Futures and forward contracts are, again, derivatives where counterparties agree to buy or sell an asset in the future. The futures and forwards are similar in many ways, except for one difference. And forward contracts are agreements made over the counter, like I mentioned earlier, whereas futures contracts are standardized and trade on specialized exchanges. So the terms that are specified on the contract, such as the expiration date, how many units of the underlying asset is represented in the contract, how is the asset is to be delivered, etc. These terms can be negotiated on a forward contract, but they are fixed and standardized on futures contracts. So usually forwards are not readily available for retail investors to trade. They are private agreements made between the buyer and seller, so the details are not made to the public. So because of that, there is a high counterparty risk. There may be a chance that one party will default. And unlike futures contracts, market for forwards is often hard to predict. So again, futures contracts are agreements to buy and sell an asset at a specified price in the future. Similar to forwards, but there are some differences. Firstly, futures contracts, also known as futures, are traded on an exchange. So they have clearing houses that guarantee the transactions. This means that you don't ever have to worry about the counterparty defaulting. The probability of that is almost never. Second, they are standardized for quality and quantity. And third, the market for futures is very large and highly liquid. So that means there is a large pool of buyers and sellers, and the market is also highly regulated. There is a certain level of oversight or control from either government bodies or industrial bodies. So this actually provides more transparency, as anyone from any part of the world will be receiving the same prices. And this is just not the same for over-the-counter markets. Regardless of where you are, you will be viewing the same prices at exactly the same time. Futures are mostly used for either hedging or speculating on the price of an underlying asset. So for example, let's assume that currently it is the month of June and farmer Sam expects a good harvest of corn at the end of the year. He would want to secure a good selling price for his produce, but is worried that overall market prices would fall by then. So to protect himself from the risk of a fall in prices in the future, Sam can enter into a corn futures contract to hedge this risk. So if Sam sells a December corn futures contract at $4 per bushel, the contract buyer is purchasing this December corn contract at $4 per bushel, and as a seller, Sam would be locking in a $4 selling price for 5,000 bushels of corn that he agrees to deliver in December. So this is just a very simple example of how futures contracts would work for hedging purposes. How are futures prices determined? So the value of the futures contract is based on the underlying asset's cash price, or also commonly referred to as the spot price. So what do you mean by spot price? An asset spot price is the current cost of the asset, so what it's currently trading for in the marketplace. And the spot price is largely influenced by market forces between supply and demand. So the futures price, on the other hand, applies to the transaction involving the asset that will occur at a later date in the future. So a futures buyer is locking in a price in advance. So futures price is based on the spot price plus what we call the cost of carry, which is the price of storage of the asset that includes interest, insurance, as well as other incidental expenses. So that's why often you find futures prices will deviate from the spot price. However, it's not as straightforward as that. Sometimes you will find that, oh, futures prices are lower than spot prices. That is because they take into account forward expectations of supply and demand and production levels in the future, so among other factors. So besides that, the quality of the asset, as well as the location of delivery, will also be factored into the price. So a wide range of traded products appear on the exchanges, which can be classified into the following groups. Futures contracts based on equity indexes. So you have agricultural commodities. You have futures based on energy, metals, interest rates, and foreign exchange. Next, an overview of the futures market. So this is a flow diagram to explain how a normal futures transaction takes place. The futures orders are placed by using a broker's trade execution platform or by giving a verbal instruction to your broker. So once the trader submits an order, whether it be a buy order or a sell order, the order will be verified by their respective brokers and then sent to the exchange, where it will be verified again and then directed to a matching engine. So if the order is matched or filled, the clearing firms on each side of the orders will complete this process by assigning contracts and then transferring the money to the participants. This whole transaction process will happen almost instantaneously. So an exchange is a central marketplace where all buying and selling orders are matched. Its core function is to ensure fair and orderly trading and the efficiency of price dissemination for its products on that exchange. The broker, on the other hand, is a middleman between the exchange and trading participants, providing the platform to access the futures products offered on the exchange. So the efficiency of the futures market relies on a large number of market participants with diverse risk profiles. The futures market is similar to any other financial market and has the following three broad categories of participants. So you have the hedgers, the speculators, and the arbitrageurs. Firstly, the hedgers. Hedgers are producers or users of the underlying asset. So farmers, mills, and grain processors are just a few examples of hedgers. Those who are hedgers, right, will at some point own the physical underlying asset being traded. The hedgers use futures to protect themselves against the risk of price swings in the future. So by using futures to lock in the current price for future delivery, they make their cost and profit margin more predictable. So in short, they trade futures to manage the price risk of their business. So the example I showed you earlier on how futures contracts work, so, it's actually an example of how hedges would use, is a scenario of how hedges would use futures. For speculators, they generally don't produce or use the underlying asset and have no interest in owning the asset being traded. So they only buy or sell futures in the hope of profiting from price movements in the market by buying a contract at a lower price and then selling at a higher price. So if prices move in the right direction of their position, then speculators would be able to profit. In general, they accept more price risk in pursuit of profit. Arbitrageurs, on the other hand, take long or short positions in the same or different contracts simultaneously to create positions which can generate riskless profits. So they trade in an extremely fast-paced environment with decisions being made immediately once or if any price distortion is noticeable. So for example, if the prices of the same commodity trading in different exchanges would be maybe trading at a premium or discount from its calculated fair value. So in such a scenario, arbitrageurs would usually look to capitalize on any or on such imperfections and inefficiencies in the market by buying the undervalued commodity in one exchange and then selling the overvalue of the same commodity in another exchange. Okay, benefits of trading futures contracts. So why should you trade futures? Futures offers a lower cost of entry into trading than, say, equities. Because futures is a leveraged product, you will be trading on margin. So margin is required to hold an open position in a futures contract and acts like a performance bond. So usually this margin is between 3 to 12% of the notional value of a futures contract. So thus, any amount of money you have to put up is much less than the actual contract size you're trading. So this is what is meant by leverage. So futures has a relatively small commission charge, where it's based on a flat rate per contract traded, as opposed to, say, equities commissions, where it's usually charged based on percentage. So if you buy every stock on the FBM KLCI index, so usually the minimum capital you need to provide is as much as 40,000 ringgit, based on current valuation. So whereas the initial outlay for one FKLI futures contract is just as much as about 4,200 ringgit, which is the initial margin amount. So I will cover more about futures margins later in this talk. Second, portfolio diversification. The futures provide access to various asset classes of the underlying instrument. This will enable market participants to build a diversified portfolio easily. Third, futures trading can be used as part of your risk management strategy. For example, let's say you are short on the KLCI index. So in the event where the market went against you and was bullish instead, you can counteract any significant shortfall if you have entered an opposite position in KLCI futures. So you can use futures to hedge against market risk in terms of anticipated or unanticipated event-driven liability in your portfolio. Fourth, high liquidity. So most futures markets are very deep and liquid, providing narrow bid-ask spreads and allow large positions to be cleared out easily without any adverse impact on prices. So it is easy to execute a trade quickly and at a desirable price because there are numerous buyers and sellers available. So futures contracts offer the flexibility to initiate either long or short positions, and this allows traders to capitalize on any opportunities during an uptrend or a downtrend. Next, You can perform short selling on futures. Short selling is permissible and applicable to all kinds of futures contracts. This allows you to enter a market no matter which direction it's heading, allowing you to profit even in a bearish market. So bear in mind that short selling for equities, however, is not legal in Malaysia, whereas it is for futures. And lastly, all capital gains in futures trading are not taxable for individual retail clients unless it is otherwise specified by the Malaysian Inland Board Revenue in the future. Okay, what you need to know before trading futures. Sorry. Okay, this is how a futures contract specification would typically look like and have these features. So here, this is an example of the FCPO futures contract, which is a hallmark product of the Bursa Derivatives Exchange. So the key things that you have to take note of is what the underlying asset of the contract is, in which case this is crude palm oil. The contract size representing the number of units of the asset in one contract. The minimum fluctuation of the contract, meaning how many points does it move by, and how much each point is worth in ringgit terms. So for this example, for FCPO here, the prices move up or down by 1 ringgit, and each 1 ringgit movement is worth 25 ringgit in your portfolio. Next, take note of the contract months, or which month the contract would be trading in. Then the trading hours, or the time it opens and closes. In this case, FCPO has 2 trading sessions in a day with a 2-hour break in between the morning and afternoon sessions. The last trading day, or the day when the contract expires and moves on to the next trading month. So the FCPO contract expires at noon on the 15th day of delivery month. Or if the 15th is a non-market day, then the next business day. Okay, you should know this. You should know the settlement method of the contract. So whether it is physically settled or cash settled. For FCPO, physical settlement is available for those who want to take delivery of the physical crude palm oil when the contract expires. However, for individual traders, it is standard practice to opt for cash settlement. You just close out your position before expiration, and you will either make a gain or loss on the spread. And lastly, you have to know the margin rate of the particular contract you want to trade before even begin trading. So the 6,000 ringgit is the initial margin amount for one FCPO contract. Traders can submit different types of futures orders that meet the criteria that they set for the trade. So you can define how and at what price you want your orders to be filled. So there are several types of orders that can be submitted through your broker. The most common being market orders, limit orders, and stop orders. So a market order is an order to buy or sell futures at the market's current best available price. So a market order typically ensures execution, but it doesn't guarantee a specified price. Okay, these types of orders are optimal when your primary goal is to execute a trade immediately. A limit order is an order to buy or sell futures with a restriction on the maximum price to be paid, or a restriction on the minimum price to be received. So this minimum and maximum price is also known as, can be also called the limit price. So if the order is filled, it will only be at a specified limit price or better. So however, there is no assurance of execution. Okay, a limit order may be appropriate when you think you can buy at a price lower than or sell at a price higher than the current quote or the nominal value quote. Sorry. Finally, a stop order is an order to buy or sell at the market price once the price has reached a specified price, also called the stop price. If it reaches the stop price, the order becomes a market order and is filled at the next available price. If it does not reach the stop price, the order is not executed. Stop orders are used to limit losses with a stop loss or lock in profits with a bullish stop. So it is important for you to understand margins in futures contracts. So before entering into a futures contract, each trader in the market is required to put up an amount of money called a margin with your broker to initiate a position in the futures contract. So this is done in good faith to protect all participants from counterparty default. So there are two types of margin in the futures market: the initial margin and the maintenance margin. Some exchanges impose the maintenance margin to be equivalent to the initial margin, so it would be best to check this prior to trading. Okay, the initial margin is the amount required by the exchange to open or initiate a futures position. Although the exchange sets the margin requirement, your broker reserves the right to collect additional margin on top of the initial margin. The maintenance margin is the minimum amount that must be maintained at any given time in your trading account. So if the funds in your trading account drop below this level, you will receive a margin call from your broker, so asking you to deposit additional funds on the same trading day to bring the account back to the minimum initial level. So for example, let's say a trader holds 10 FCPO contracts. So the initial margin is 6,000 and the maintenance margin is 5,500. So for 10 contracts, the total is 60,000 and 55,000. So on day one, for example, let's assume the trader puts in 60,000 to begin trading. On day two, the trader has made some losses in his account, and then his resulting balance is 54,000, which is 1,000 short from the total maintenance margin of 55,000. In this instance, a margin call will be triggered, and the trader has to deposit 6,000 ringgit to bring it back up to the initial level of 60,000. Okay, so if the trader is unable to meet a margin call to cover a market move against him, his position will be closed out, and then the resulting loss deducted from the margin before the balance is returned. Or otherwise, if the trader wants to cash in on the profits he realized in a futures transaction, then the margin will be returned at the time the contract is closed out. The margin rates are set by the exchange and is subject to change from time to time. So to summarize, the futures margin is the amount of money you must deposit and keep on hand with your broker. So it is not a down payment, and you don't own the underlying commodity. Okay, another important concept in futures trading is leverage. So like I mentioned earlier, futures contracts are leveraged instruments. So with leverage, you are able to get exposure and the underlying asset with a relatively smaller capital. And for example, if a futures contract has a value of 70,000 ringgit, you would only need to provide a capital of 4,500, which is the margin amount, to start trading. In effect, the leverage offered is 15 times. However, the greater amount of capital you apply, the higher the risk you assume. Leverage is a double-edged sword, so it increases your winning or losing position equally. So to illustrate, let's say you are long, or you bought a FCPO contract priced at 3,500, So your leverage in this position is about 14.6 times because you only put in a 6,000 ringgit margin out of your notional value of 87,500. So if the market went up by 0.8% or by 28 points, your portfolio would gain 700 ringgit. So an 11.7% return out of your initial outlay of 6,000. However, on the flip side, if the market falls by 0.8%, 8 points, this can equally cut 700 ringgit out of your position, which is a loss of an equal magnitude as when the market went up in the previous example here. So again, leverage is a double-edged sword. It increases your gains and losses equally. So moving on to the last portion of this webinar, I will be giving an example of a simple trading strategy for you to start off on. So the most often used strategies in futures are pretty simple. So you buy if you think prices are going up, or you sell if you think prices are going down. So should you buy or sell? If you anticipate the market to rise, you should be going long by buying into a futures contract. So if the price rises from the price that you first entered, you'll be in profit. The investor would typically cash in their gains by closing off their open position, and in this case, by selling off the contract when the price has increased. Likewise, if you anticipate the market to fall, then you should be going short by selling your futures contract. So you would close out your open position by buying back the contract when the price has decreased. So it's a profit when you sell at a higher price initially and then buy at a lower price later. Okay, using the FCPO contract as an example. So on the left-hand side, you have the scenario where market conditions for FCPO are bullish and you expect prices to rise. So the first step is to go long with a FCPO contract currently priced at 3,000 per metric ton. So if your expectations were right and FCPO rises by 90 points to 3,090, you close out your initial long position by selling the FCPO at 3,090. Then your total gains from this strategy is 2250, which is 25 ringgit per tick, per point, multiplied by the 90-point move in the right direction, because every 1 point move is worth 25 ringgit. So note that is, so just note that it is a paper gain that will be added to your margin balance in your account and won't be realized unless you decide to liquidate your position. On the right-hand side, you have the scenario where market conditions are bearish and you expect prices to fall. Okay, step one, you go short one FCPO contract at 3,000, assuming the market went your way and FCPO falls to 2,910, a 90-point reduction from 3,000. So the next step then is to close out your initial short position by buying the FCPO contract priced at 2,910. So your total gains from this strategy alone is like the previous left-hand side example, 2250, because it's 25 ringgit multiplied by the 90 ringgit point move. So there is no guarantee that you'll be making gains 100% of the time. So please take note that the market can either go along your expectations or run totally against them. So for that, you need to have both a knowledge of fundamental and technical factors in order to make informed trading decisions. So in order to have an effective trading strategy, you need to have a good risk management plan in place. So risk management is an important aspect of trading. It does not offer a guarantee that large losses will not occur, and it does not eliminate the possibility of a total failure. Risk-taking is inherent in all forms of economic activity, and so the possibility of failure is never eliminated completely. It's a dynamic and ongoing process, reflecting the fact that the risk assumed can be difficult to measure and is constantly changing. Here I have 3 simple variables to manage risk. The first is on deciding which types of futures contract to trade. So some markets can be more volatile than others. So this means that some markets have the potential to make or lose more in dollar terms each day. So for example, if the S&P 500 moves about 10 points per day, and each point is worth $50, so you might experience a $500 fluctuation in your account for one day. Or another example is crude oil, which can move by about $1 a day. So due to its tick value, this can equate to a potential of a $1,000 swing in a day. So knowing the typical profile of a futures market will help you decide if one market is riskier or suitable to your trading strategy. The second way traders can control risk is the number of contracts they trade. A market exposure is increased by more contracts and decreased by less. Okay, you should only trade a certain number of contracts based on risk scenarios for that number of contracts, and not simply trade the maximum number of contracts that you are allowed based on initial margin requirements. Okay, the third way is to set stop loss orders that are within your risk tolerances. Setting stop loss orders provides protection if the market does not move in your desired direction. Stop losses are an essential strategy when trading as an individual trader and can assist in exiting any open positions when triggered by a price level you have set. Now, this helps to prevent any loss scenario which is larger than you can actually handle. So risk management is very important for a trader. The key to the success of a trader is understanding the rules of not only how to create a profitable position, but also how to manage a losing position. So Kenanga Futures is an award-winning Malaysian-listed derivatives broker with over 25 years of expertise in the Malaysian-listed derivatives market. So we provide daily commentary and market updates for you to keep you informed on your trading decisions. So with our online trading platform, you can have access to the Hong Kong, Malaysian, and US derivatives market and trade selected products either on your desktop or on your mobile. You will also have easy access to real-time market data along with the flexibility to trade on the go. So that concludes my session. Thank you very much for listening, and now we can proceed with the Q&A session.
Thank you, Ms. Jen, for the presentation. We hope you find it useful and informative. Okay, next we proceed with the Q&A session. Question from Mr. Sekaran. What is the safer price to buy long right now in KLCI futures, August or September contracts, and what is expected KLCI index at the end of December?
Hi, Mr. Velasamy. Okay, so we do provide daily market commentary with our trading recommendations. So if you would like, we could actually send you a copy of, we can actually add you into our mailing list so you can receive price updates every day for the KLCI index.
Okay, next we move to the next questions. Can we, from the result more, what can we trade twice in the morning session? For example, enter at 10:30 a.m. and exit at 11 a.m. Then enter again at 11:30 a.m. and exit at 12 p.m.
Hi, Mr. Rizal. Yes, as long as the market is still open, you can. So 11:30 to 12 p.m. is still within the first morning session, so you can still trade at that time. But bear in mind, it will close for a 2-hour break and then restart again in the afternoon.
Okay. We noticed that we are still receiving a question from you. We would like to thank you for your warm participation today. Due to time constraints, we will have to end the webinar session today. We apologize that we are unable to answer some other questions posted, and we will reply to your registered emails. However, should you have any further queries, please drop us an email to Kenanga Futures Marketing to futuresmarketing@kenanga.com.my. Thank you, everyone. We appreciate you being here and hope that you enjoyed the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. We will post the link in the chat box. Again, don't forget to register for our next webinar. Thanks again for joining us, and hope to see you again in our next webinar. Good night and stay safe, everyone.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.